Okay, so now we're going to take a look at trailing stop orders. Trailing stop orders are a order that I actually use with almost every trade that I place. I oftentimes pair them with a trigger, which is a feature I'll go over in another video. But so now let's take a look at why and how you would use a trailing stop. For an example here, we're using SLV, iShares Silver Trust, the ETF. Now let's say that instead of looking at real time here, let's say that we're back here in 2011, the end of 2011, beginning of 2012, and we want to pick up SLV thinking that it will move upward. So as I mentioned in another video, if we were to use a stop loss, that is just set at a specific price to protect us from losses. That really doesn't give us much flexibility. Whereas the trailing stop gives us a lot of flexibility and allows us to really automatically, without having to do anything, allows us to follow the trend, and then the order will automatically sell the stock if the trend reverses on us, or of course if the trend just continues downward. Let's say we bought it here and it keeps going, it would also protect us from losses. So but let's just say, as an example, we purchased the ETF. We want to set a trailing stop at $2. Now what that'll do is what that $2 means is that the order will be executed if and when the price of the stock is $2 lower than the highest previous price. $2 or more lower. So that's a bit confusing. So let me just use an example here. So let's say that we purchased it here and we set a $2 trailing stop. And let me mention real quick that you do want to use a pretty decent cushion, $2 being a good amount when using trailing stops, because obviously you have a lot of this movement. Stocks don't perfectly just move directly upward. I wish they did. So anyway, so we purchased it here. We set a trailing stop at $2. So this ETF moves up, hits this peak, and then falls. But this fall was not $2 or more, meaning that this price here, this lowest price here, was not or is not $2 or more lower than this highest price. Again, it's the highest previous price. It's a trailing stop. It's kind of like a tail. So therefore, our order was not executed. We automatically continue to hang on to the ETF. So the order is still active and not executed. So basically, the ETF continues to move upward, hits this peak, falls again, but again, not $2 or more. So it doesn't sell. So we continue to hang on to it. Does some sideways movement, gets close to selling as it hits this peak and then falls. That's almost $2, but not quite there. But then, so we're still in the stock. Then it continues to move all the way up here above $36 and then falls drastically this day. So therefore, this day, our stock would have been sold right here, right above $34. The reason is this was the highest peak it hit, about, let's just say, 36.50. I'm not sure if that's entirely true, but 36.50. It would have then sold as soon as it hit 34.50. But we really didn't have to do anything. We just purchased this, set our trailing stop, and went about our business. So a good amount of gains without having to do anything. So again, a trailing stop is a great thing to use. Of course, this is an ideal condition because the stock moved upward, but it will also it can also protect you from losses. So let's say that we purchased maybe around here, somewhere in this area, and set that we purchased in this area, obviously hoping that it was going to move upward again, and then set a $2 trailing stop. Well, we would have then been stopped out pretty quick here, only within a few sessions, but we are protected, or we were protected. We saved ourselves from further losses, as you can see here. So again, a trailing stop order is a a great order to use, especially for those who aren't in front of their computer all day long, and you know, maybe, like I said, midterm. I consider this midterm, a couple months, mid to long-term traders who aren't just buy and hold kind of traders. And let me show you real quick here on my Options House platform how to your platform's probably going to look different if you don't use Options House, obviously. But let me just show you here how it would look, kind of get the idea of how to actually place this order. So we would set a trailing stop at saying that the last price down, meaning that it's below, let's say, $2, good to cancel. Then we would sell. I generally just sell at market. I don't try to get too complicated with using a limit or anything like that. So I just pick market is what I do. So again, what this does is exactly what I mentioned earlier when looking at SLV, is this would set our trailing stop at $2. So again, I'll show you in another video why we might want to use a trigger. I'll show you that in the next video.